Very good morning to all. I hope you are doing great. I'm also good. Very warm welcome to my YouTube channel. My name is Dr. Reina and I am so happy to have you here. In today's video, we are going to talk about this topic: preparation of cost sheet, marginal costing, cost volume profit analysis, and standard costing and variance analysis. So let's understand these topics thoroughly one by one. So first topic we have preparation of cost sheet. So let's understand this topic thoroughly. Basically, cost sheet is a statement that provides detailed cost information regarding the total cost incurred in the production of goods or services. It helps businesses to analyze cost, setting selling price and make financial decisions. Okay? So basically, total cost incurred for the production of goods and services, that is called cost sheet. And so it is very helpful for the businesses or the companies in that way when they want to analyze the profit and loss for their business. So in that case, they can analyze the cost and selling prices of the product and services and accordingly take the decision in the market. So next topic we have component of a cost sheet. A cost sheet generally consists of the following elements. So these are the elements. First, we have prime cost. Prime cost, that means the direct cost incurred in production. For example, direct material, direct labor, direct expenses. We want to make a laptop. So we need a material for a laptop, and we also need a engineer and laborer who can connect all the parts of the laptop. And we also need expenses, we also need money for repairing, for maintaining the all the things. Okay, so this is called prime cost. Next we have factory cost, and which we also called works cost. It is basically prime cost plus factory overheads, which include the indirect material, indirect labor, and factory expenses. Okay, and next we have total cost of production. That means factory cost plus administrative overheads. That means office expenses. Next we have the cost of goods sold. That is we also called COGS, total cost of production minus closing stock of finished goods. And next we have total cost, that means the cost of sales, that means the cost of goods sold plus selling and distribution overheads. Next we have profit and loss, that means selling price minus total cost, that is called profit or loss. So this is the format of a cost sheet below in a simple format of a cost sheet. And these are the particulars and these are the amounts. Amount may be anything according to the material. First we have direct material consumed. Okay, direct labor, direct expenses, prime cost, factory overhead, factory cost, and administrative overhead, where the total cost of production, opening stock of finished goods and closing stock of finished goods, cost of goods sold, and selling and distribution overhead, total cost, and profit and selling price. So this is the format of cost sheet. Okay, next we have the importance of cost sheet. Basically, cost sheet helpful to control the cost and reduction. Apart from that, it adds in pricing decision. Moreover, it facilitates cost comparison over time and also support managerial decision making. So I already mentioned in the first slide, basically cost sheet is a statement that provides the detailed cost information regarding the total cost incurred in the production of goods and services. Okay, so next topic we have the marginal costing. So let's understand this topic thoroughly. Basically, marginal costing is a technique where only variable costs are considered for decision making, while fixed costs are treated as period cost and written off against revenue. So these are the features of marginal costing. Fixed costs are not included in product costing, and contribution is the key measure. And contribution is how we find out the contribution. That means we have to subtract sales, we have to subtract variable from sales. Okay, so in that way we can find out the contribution. It is used for short term decision making, and break even analysis is a major application in case of marginal costing. So next we have, these are the formulas that we use in marginal costing. First we have contribution. Contribution, that means the sales minus variable cost. And next we have the profit. Profit, how we find out the profit? Contribution minus fixed cost. And how we calculate the PV ratio? This is calculated by contribution divided by sales into 100. And this is the break even sales. We can find out break even sales when fixed cost is divided by PV ratio. And margin of safety, that means actual sales minus break even sales. Profit at desired sales is equal to sales into PV ratio minus fixed cost. And these are the applications of marginal costing, where fixing selling price, profit planning, and it make or buy decision according to the marginal costing, and decision on special order. It is very helpful in determining break even point. Okay, so these are the very important formulas, and most of the question that asked according to these formulas in the net exam. So be next topic we have cost volume profit analysis. So it is also called CVP, cost volume profit, examines how changes in cost and volume affect a company profit. It is used for planning and decision making, and these are the assumptions of cost volume profit analysis. First assumption we have, selling price per unit remains constant and variable cost per unit remain unchanged, and fixed costs are constant. Sales volume is the key determinant of profit. Next we have the key elements of CVP analysis, in which we have break even analysis and determines the point where total revenue equals total cost, where that means where no profit and no loss. This is called the break even point. Next we have the profit volume ratio, that we can calculate PV ratio. So that means the relationship between the contribution and sales. Next we have margin of safety, to access the actual sales over break even sales. Next we have the sales mix analysis, that is helpful, or that can help to evaluate the profitability of different product. Next we have the break even chart. It is basically visually represent the sales, total cost, fixed cost, and break even sales, adding in the financial planning. Next we have the standard costing and variance analysis. Standard costing is the cost control technique where predetermined cost standards are compared with actual cost and differences are analyzed. And these are the objectives of standard costing: cost control and reduction, and performance evaluation, budgeting and forecasting, identifying inefficiencies. So these are the types of standards in standard costing. Okay, first we have ideal standard, second we have attainable standard, current standards, basic standard. Assume perfect efficiency, and in case of attainable standard, which is based on realistic conditions, and current standard, that means the based on current operational efficiency. And next we have basic standard used as long term benchmark. Okay, so these are the variance analysis. Variance analysis basically examines the difference between standard and actual cost to identify performance definition. Okay, so these are the formulas, and these are the interpretation of these variable types. So you can go through these formulas. Next, we have the importance of variance analysis. It is helpful in cost control and also identifies operational inefficiencies and improves the budgeting and forecasting. It also assists in managerial decision making. So, come to the conclusion of these topics. Basically, understanding cost concept like cost sheet, marginal costing, CVP analysis, and standard costing helps in businesses in cost control, decision making, and profitability analysis. These techniques are crucial for effective financial planning and business growth. So these are the multiple types question and answer based on these topics. So first topic we have preparation of cost sheet. So first question we have, in a cost sheet prime cost include direct material, direct labor, and direct expenses. Okay, so I already mentioned in the first slide. This question cover under this that topic. Okay, so second question we have, the total cost of production is calculated as. So it is calculated when you have to add prime cost plus factory overhead and administrative overheads. So in that way you can calculate to total cost of production. Next we have, the selling price of a product is determined by adding profit margin to the cost of sales. And next we have the marginal costing, consider which type of cost for decision making. So right answer is variable cost only. Next topic we have, which of the following statement is true for marginal costing. So right answer is contribution is calculated as sales variable cost. Next topic we have, marginal costing is most useful for which type of decision making. So right answer is B, short term pricing and production decision. Next topic we have cost volume profit analysis, which we can call it CVP. So first question based on this topic is, break even point is where is the total revenue is equal to total cost. That is that point we can call it cost volume profit. Next we have the formula for PV ratio is fixed cost sales into 100, contribution divided by sales into 100. So right answer is contribution divided by sales into 100, that is called PV ratio. Okay, so this is the question based on above formula. If the contribution is 40,000 and sales revenue is 1 lakh, so what is the PV ratio? So right answer is this one. So we can apply here formula, PV ratio is equal to contribution divided by sales into 100. So we have given that 40,000 is the contribution and 1 lakh is the sales. So we divide this one, then after that we get 40% is the PV ratio. Next question we have, margin of safety is calculated as. It is calculated as actual sales minus break even sales. Next question we have, the standard costing and variance analysis. So here variance analysis helps in comparing standard cost with actual cost. And this question is based on this topic, standard costing and variance analysis. Next question we have, the formula for material cost variance is standard cost minus actual cost. Next question we have, labor efficiency variance is caused by. So right answer is C, difference in standard and actual hours worked. So next we have the practical application questions. So this is the right answer of this one. 500, not 500, sorry, 5000 units. So in that way you can solve this question here given the hint. Okay, and proper explanation also. Break even sales is equal to fixed cost divided by contribution. So you can just put the values here. First of all, you have to calculate the contribution. Contribution you can find out where selling price minus variable cost, and we have selling price is equal to 25 and variable cost price is 15, so we get 10 contributions. So by using this formula, break even sales, then 50,000 is the fixed cost and 10 you have a contribution. So we get the 5,000 units. Okay, next question we have, if the break even sales are 80,000 and the actual sales are 1,20,000, what is the margin of safety? So right answer is 40. And in that way you can calculate, like we have a formula of margin of safety where we can calculate this one with the help of this actual sales minus break even sales. So 120 lakh minus 80,000, then we get 40,000. Next topic we have cost sheet preparation. So these are the questions based on this topic only. The cost incurred on direct material, direct labor and direct expenses is known as, it is known as prime cost. Next question we have, the factory cost is also known as, so right answer is work cost. Next question we have, which of the following cost is not included in primary cost? So right answer is D, administrative overhead. Next question we have, selling and distribution overhead include, and the right answer is A, advertisement expenses. Next question we have, if the total cost of production is 120 lakh and selling and distribution overhead are 30,000, then the cost of sales is, and the right answer is 150,000. Okay, 1,50,000. So we can calculate the cost of sales when we add the total cost of production, selling and distribution overhead. So 1,20,000 plus 30,000 is equal to 150,000. Next we have the marginal costing is also known as absorption costing, direct costing, opportunity costing, historical costing, and the right answer is direct costing. Next question we have, in marginal costing, which cost is considered as a period cost? And the right answer is fixed cost. And next question we have, the term distribution or contribution refers to. So contribution we can find out when sales, when we subtract variable cost from the sales. Next question we have this one, and this question is based on previous formula. Okay, so we have given already sales 80,000 and variable cost is 50,000. So what is the contribution? So you can easily calculate this one by using this formula. Contribution is equal to sales minus variable cost. That means the 80,000 minus 50,000 is equal to 30. Next question we have, the contribution we have given 40 and fixed cost is equal to 25. So in that case you can calculate the profit. Profit is equal to contribution minus fixed cost. So contribution is 40,000 and the fixed cost is 25,000. So we get the result is 15,000. Next topic we have cost volume profit analysis, and these are the questions based on this topic. Which of the following statement is true about break even analysis? And the right answer is C, profit is zero at break even point. And the next question we have, if fixed cost is equal to 60,000 and contribution per unit is equal to 15 rupees and break even sales in units will be these. So right answer is 4,000 units. And we can calculate the break even sales when we have to calculate the fixed cost divided by the contribution per unit. So we have already mentioned that the fixed cost is 60,000 and contribution is 15. So by dividing this one, so we get as a result is 4,000 units. Next question we have, the margin of safety is 50,000 and the PV ratio is 40. So what is the profit? So profit is equal to marginal of safety and PV ratio. So this is the right answer, 20,000. Next question we have, if actual sales are 1,20,000 and break even sales are 90,000, then margin of safety is 30,000. And this is the explanation of margin of safety, actual sales minus break even sales. 120,000 minus 90,000 is equal to 30,000. Next topic we have standard costing and variance analysis. And basically variance analysis is used for identifying deviation in cost control. Next question we have, material price variance is caused by, and the right answer is change in material price. Next question we have, if standard cost is equal to 60,000 and actual cost is equal to 55,000 and the total cost variance is 5,000, and we can calculate in that way, variance is equal to standard cost minus actual cost. Okay, so we get as a answer 5,000. Labor efficiency variance is calculated using the formula. So this is the right formula, standard hours minus actual hours into standard rate. Next question we have, which variance occurs when actual labor takes more time than the standard time allowed? And the right answer is C, labor efficiency variance. Next question we have, which of the following variance measures the impact of a change in selling price per unit? And the right answer is D, sales price variance. So that is all about for the today's video. Thank you so much. If you like this video, then do like and comment on this video, and also subscribe my channel. Thank you. Bye bye. Take care and have a nice day. Keep learning, keep growing, keep signing.